as you mentioned, I work for Brand Capital. It's a business line for Bennett Coleman and Company. We are India's largest media conglomerate. And what my business does is very interesting. We work with high growth B2C businesses in building their brand, and we actually partner them in creating value. And we're very prolific with our deals. We've, in the last 7-8 years now, in aggregate, we've deployed about 7,000 crores of capital in more than 400 deals. And we meet a lot of entrepreneurs every year. Every year we close about 100 deals, which is roughly 2 deals every week. And that perhaps makes us India's largest venture platform. And in the course of all these deals, we meet a lot of entrepreneurs, many entrepreneurs across many different verticals. And of course in the e-commerce vertical as well, because that's a very high growth B2C vertical. It's a very special place in our heart. As it were, I think the economics of retail in India and the opportunity for retail in India, I think is such that unlike consumer America, in 10 years time, 20 years time, when we look at consumer India, e-commerce itself will have a very important place in the economy. Therefore, we're very actively engaged in this space, and what I wanted to do today is really share some insights which I have collected over a very long period, meeting many entrepreneurs in the e-commerce space. And there's this little story which I tell entrepreneurs to share my own learning across so many years. And I thought it would be best if I could share this story with a very large bunch of people. You're all in and around the e-commerce space. So this is the story of John Smith. It's of course narrationally reconstructed, and the names are changed. So John Smith and his grandmother Constantine, and this is a story which is set in the mid-19th century. So John Smith was actually a furniture businessman, and he was brought up by his grandmother. And his grandmother was a very wealthy lady from a timber trading business. But her son and John's father passed away very early, and therefore John was brought up by his grandmother from a very early age. And he was fortunate in that sense because very early on he got, of course, the love and the affection of a grandmother, but also the wisdom of the grandmother, and became a very precocious child, very hardworking. You see him in this picture, working in the timber factories with the laborers. There was no need for him to do that, but that's what he would do. And not only was he very hardworking, diligent, precocious child, he was also very enterprising. So, as he grew up in the timber factories, he thought to himself, why should we be selling timber? Why don't we do something more to the timber so that we can get higher profit margins, etc., etc. And in the course of those years, he met with a Chinese traveler, and he saw this design for chairs, and he said, this is so fascinating. So if I could take this design and I could sell these chairs to the UK market, that would be so amazing because my profit margins would double. And so that's what he did. So he got down, created his own factory, would be there in the factory himself, working with the workmen and churning out the chairs, and that was just great. Now, not only was he hardworking, he was also very good with marketing. So he said, listen, why do we sell chairs only in the UK? Why can't we sell chairs to the rest of Europe? Imagine what that could do to our business. So that's what he did. In that time, in the mid-19th century, there was very few means of communication. So that's what he would do. He would write letters to buyers all over Europe and grew his business manifold. Now, something very interesting happened towards the end of that century. So in in 1860s, the transatlantic telegraph cable was laid between Europe and America. And very soon thereafter, there was another breakthrough in communication technology, which was the telephone was invented. Now, John, who was very industrious, very clued on, very quick on adopting technology for his business, said, you know what, this is very interesting. Now, not only can I sell to all of Europe, I can actually sell to all of America as well. So that's what he did then. So he got this telephone and he installed it in his office, and he had someone make the calls to buyers in America, and business was just booming. And you see in this picture here the old workshop, and this is the new workshop, and it's just not enough time to turn out enough chairs. And the social repute and the acclaim, everything followed. Here you see him with the mayor of Bath at a social event. And it was just going absolutely fine, except that after some time, he just couldn't cope up with the finances. And he was just struggling with the cash flows and struggling with how to pay off the money, and eventually, in a few years' time, ended up with bankruptcy. Now, at that point, grandmother Constantine was called back into the business to, of course, to bail him out, which she did. She was a very old lady at that time. And she couldn't figure what went wrong. He's such a sensible kid, works absolutely hard, seemed to be working on the right strategy. What went wrong with this business? And she said, I'm too old to figure this out. She said, let me ask somebody. So she had a friend who was a furniture auctioneer in America. And so she reached out to this guy, and they communicated back and forth about really what really went wrong with the business, what was wrong with that strategy. And here's what he said. So these are John Smith's chairs, as made and exported by him to America. And these are chairs which were already available in America. So it's pretty apparent that whoever sold him the design sold that design to other people as well in many other places. And it's also very clear that when you sell a product like that in a market which already has a product like that, you will not have any pricing power. And that's what's getting translated into the cash flow. So if you have no pricing power, it's obvious that your profits will forever be under pressure. And therefore these principles around differentiation being very central to pricing and pricing power, and pricing power being very central to sustaining profitability and being attractive for capital allocation. Now these are principles which are very old. So this is a 19th century story. These are true generically. If you read Warren Buffett and if you read what he writes about brands and customers and loyalty and pricing power and stickiness and moats leading to higher returns on capital and sustainability, these are time-tested principles, right? Now these are principles which were true before the telephone was invented. They were true after the telephone was invented. If you go back further in time by a few centuries, there were also other breakthroughs in communication. At some time paper was used to communicate, but then they started using pigeons to communicate. So countries were run using this communication medium, love affairs were run using this medium, wars were run using this medium, businesses were run using this medium. But these principles were still valid. So you need to differentiate, get better pricing, have superior returns on capital, you'll be sustaining your profitability and you'll be attractive to capital. If you roll forward a few centuries, the printing press was revolutionary in its own way. It allowed mass dissemination of information. So what was one-on-one communication became mass communication. So it's a breakthrough of that time, but the principles are still valid. We roll forward a few more centuries, the telegraph, which not only allowed online communication using telegraphy and the Morse code, etc. So you could, in business terms, you could actually communicate with customers online. But the principles are still valid, mind you. You roll forward a few more centuries, sorry, one more century, and then you have not only a live one-to-one communication, you have live one-to-many communication using satellites, but these principles are still valid. And these principles will also be valid at another time when there was some more breakthrough, which is really when the internet came into play. And these principles, whenever I talk to people, these are, of course, these are understood, these are first principles, they are fundamental, they are, some people say they are motherhood, and so they are accepted, except when you meet this guy, or you meet someone like him, and then all our principles, all our fundamentals, all our first principles become last principles. We don't want to use any of the fundamentals, and then something new is being created which never was, and then people start saying things like, we are an internet business, and I almost shudder, because in my mind, the internet is the current medium of communication. There have been many mediums of communication, and these media have changed. So perhaps, as we go forward, there will be more layers of interactivity built on the internet. But that's a communication medium. The predominant character of the institution is really that of business. Now, there are many socio-economic institutions in the world. There are governments, there are NGOs, there are businesses. Businesses are businesses. That's their predominant character. The communication medium doesn't define your predominant character. In fact, in India, with internet penetration being what it is, and e-commerce penetration on top of that being what it is, this would be a representation of the Indian consumer market being the largest circle, the internet users being the smaller circle, and the e-commerce users on the internet being in the smaller circle. So in fact, in India, the addressable market would be much larger for a business rather than a internet business, in theory. Now this is the other thing that I commonly hear. So we're not making much profit. Some people are not making positive gross margins, but the growth is just great. We love the growth. We like a rocket, and I have no words for such meetings except that I can't push this picture out of my head of where these guys are heading. This is another interesting discussion, and it's a long one, but just to present some thoughts. So internet businesses should advertise on the internet. If you study marketing, if you study branding, if you study basic business theory, it's established that communication, branding, of course, as tools for differentiation. I'm not saying that is differentiation, but as supporting framework for differentiation. It needs a media mix. It needs a media mix because the communication itself has many objectives. The first of which, of course, is to develop your own positioning. So this, hypothetically, is to say this is a superior product, or this is a affordable premium product, or whatever else the positioning is. That to communicate that positioning, to make more people aware that there is such kind of a solution, to create and to reinforce credibility, to address barriers in a mind. So for example, insurance. So you'll see insurance ads, but you never buy insurance because it's not for you, but it is for you. So you need a communication medium which allows people to get over their barriers if you think they're relevant, and of course to maintain recall, and in more recent years to drive affinity towards the brand and its proposition and its character. So with all these media objectives, brand objectives, just one medium is never going to be adequate. There are so many media, each one of them have their own ability to drive certain aspects of this communication, but they're not strong across. So the need for a mix of marketing media is just cannot be overstated. And that's not to say that there is a need to break clutter in these media itself. So that's another creative or whatever else we can call it. So we leave that out for now. But the need for one to use a mix of media to communicate with customers is just timeless. And this is the last one, which is unstatedly that we are an internet company, we will never be able to afford traditional media, and that's really where I want to end my discussion, because that's really what brings me back to who I am and what we do, and without doing a very long sales pitch. So we partner with high growth B2C companies, including internet companies, in making that communication happen and sharing the risk of the business with them. So with that, that's my short story, and as I said, the name was changed for. So this is the firm, and there's 2 or 3 other firms which actually are from that era and are perhaps still surviving. So that's for anyone else who's interested. So I'm happy to take questions at this point. If you have any clarifications.
Yeah, this is Venki Vijay. My question is,
Hi,
do you invest cash or you invest with your advertising support?
So we are a division of Bennett Coleman, and our mandate really is to build B2C companies in partnership with them. And our mode really is that we take advertising inventory from Bennett as capital, and that is the capital that we deploy working with B2C companies. Now, B2C companies, when they plan their growth and their investments, a significant bunch of that, a significant portion of that is actually towards brand, and that's the space that we are relevant for. That's the proportion we are relevant for. So to answer your question, we offer ad space as capital.
You mentioned that there's a negative perspective that we have, high growth, but we're working on negative margins, negative gross margins. But you said that you work with companies with high growth. So is there a difference between the two? I mean, you're looking at big growth but negative margins.
Yeah.
Is it a misconception, or do you support that view?
No, we love growth. Everyone loves growth, but we love the ability to price, and we love the ability to differentiate. We love the ability to eventually maintain good, healthy margins. We would shudder at negative gross margins, is what I had said earlier. So if your gross margin is negative, there's something grossly wrong in the way the business model is structured. That's generally how I've seen it. But again, I mean, these are generalizations. So I mean, I'm sure there are situations where for a certain phase or for a certain product line, you may want to strategically have certain pricing, but it may not. I don't think you can specifically translate it in every case. Yes and no. If you mean by mentoring, are we participating on the board? We generally don't, because for us it causes the possibility of editorial issues. But we do work with all our partner companies in optimizing their marketing investment, the brand investment. So we actually have a team of 20 senior brand professionals, brand communication media professionals, who actually work with our partner in optimizing their brand investment over 3 or 5 years. So to that extent, yes. Okay. Thank you very much.